My clock just turned over to 3 o'clock, so it is the top of the hour. Thank you, everyone, for logging in on this beautiful sunny afternoon. This is our first Wisdom and Wealth of the new year, so I'm really excited to present this afternoon. My name is Alan Hensley. I am a wealth advisor here at Financial Insights Wealth Management. I'm also the vice president. And today's topic is new rules and new opportunities planning for 2026. So we like to do this at the start of the year. There's a lot of updates to retirement accounts, and there's also a lot of new tax rules this year. We're going to try and touch on kind of the main topics. Obviously, we can't cover everything today, but we are going to get into it. So hopefully, if you're paying attention at home, if you're taking notes, that's great. But just a little bit of housekeeping. If you have a question, there should be a Q&A button down there at the bottom of the screen. Feel free to click that, type in your questions. I'll try and keep this conversational, so I'll check in every once in a while if there's any questions. But also, we're going to save some room at the end. So this whole presentation should be about 35, 40 minutes. And then I do want to save some time at the end for any questions. And then this will be recorded. So don't worry if you miss something. If you have more questions, definitely feel free to reach out, shoot me an email, give me a call. Happy to chat offline. But we're also going to put this on our YouTube channel in the next week or so. So if there is anything that we go through quickly, just know that you'll be able to watch this later, hit pause, and kind of take some time there. So, with all that said, I do want to dive in because there is some great stuff we're going to talk about today. And let's just look at the agenda real quick. We are going to talk about retirement account updates. So, like I said, there's some new rules. There's also just some updated amounts that we want to discuss. And then I am going to talk a little bit about the highlights from the One Big Beautiful Bill Act and taxes. Quick side note, I am going to say OBA throughout the rest of this presentation. It's a kind of a word salad to say One Big Beautiful Bill Act over and over again. So if you hear me talking about OBA, that's what I'm talking about. And then I do want to just touch on some inheritance issues that we've seen, that we've kind of we've come across when it comes to some of our clients, definitely things that we're dealing with. Estate planning can be complicated, but also on the other side, when you're inheriting money, there are some specific rules and things that you should just be aware of. So we're going to cover those, and then I do want to touch on at least a couple of highlights when it comes to estate planning. We're not going to get too deep into the weeds today with estate planning, but if this is a topic that you're interested in, just know that that's what we try to do at a future Wisdom and Wealth webinar. So keep that in mind. And then just in general, if we do have some time at the end, I'll just kind of share what we're keeping an eye on, as a wealth management firm. What are we paying attention to? And maybe this might apply to what's going on in your life. So with all of that said, I'm going to kick things off. Let's talk about retirement accounts. And specifically, I want to start with employer retirement accounts. So that means if you're still working, you're still contributing to, let's say, a 401k or a 457 deferred comp plan, or maybe a 403b. There's a whole alphabet soup of different retirement accounts available to you. But this is, again, if you're still working, this is definitely going to apply to you. Or maybe you have a family member, maybe your kids or maybe your grandkids just got their first 401k and they're trying to figure out how it works. The good news is for 2026, the deferral limit has gone up. So if you're able to, you can contribute up to $24,500 into your plan. And there is a new kind of catch-up wrinkle that I want to discuss. Specifically, if you are over the age of 50, on top of the 24,500, you can do another $8,000. And this is one where I do make the point, you don't have to be 50 technically, but if you're turning 50 this year, this applies to you. So if you're 49 today, but you're going to be 50 in a couple of months, this catch-up rule applies to you. But as you can see down there at the bottom of the screen, there is this brand new rule that came out last year. We're calling it the super catch-up. But if you're between the ages of 60 and 63, instead of the $8,000 catch-up, you can actually do 11,250. So I do want to just repeat that one more time. It's not like after age 60, you can do the $8,000 catch-up plus the 11,250. No, it's one or the other. It depends on your age, but that is in addition to the regular contribution limit of 24,500. So again, if you're working you've got a 401k or one of those other retirement accounts, and you're looking for just ways to save more, if you're over the age of 50, and definitely if you're between ages 60 and 63, there's a lot of money that can go into these retirement accounts. But what I want to highlight, and you'll see this throughout the presentation today, there's going to be a couple of slides where you see that new sticker on the right there. There is this new rule that kicked in this year for those that are quote unquote a high earner, and the IRS is defining that if you make over $150,000. And if you're making catch-up contributions to a 401k, so again, for those over the age of 50, those catch-up contributions, those will have to go into a Roth 401k. So that is totally new. In the past, when you made contributions to a traditional or a tax-deferred 401k, your full contribution limit plus the catch-up, all of that could be pre-tax. But now, if you're making, let's say, the full 24,500, and let's say you're 55 years old and you want to do another $8,000, that 8,000 will have to go into the Roth 401k. And so just know that potentially, this could affect your taxable income for the year. If you previously you're used to putting all of that into pre-tax, well, just know that now up to 8,000 of it is going to be taxable. And it's still a great idea. Don't get me wrong, if you're looking for to save more, but this is going to be a little bit different going forward. Now you'll have this Roth version of the 401k, and administrators, 401k administrators are still kind of playing a little bit of catch up, making sure that they get this done. But if your HR department hasn't talked to you about this, maybe you might want to ask just to make sure it is happening. But yeah, just know that 401ks have this really high ceiling. And I do like to call out, if your work offers a matching on your 401k, let's say if you put in 6%, they'll also put in 6%. That's great. But just know that the match is not the max. The maximum amount you can put in, though, are those numbers you can see there at the bottom of the screen. Doing the match is great, but just know that there's probably a lot more that you could be doing. All right, so those are the highlights and kind of the big things when it comes to employer retirement accounts. Let's switch gears and talk about individual retirement accounts. So IRAs, traditional and Roth IRAs is what I want to talk about. So new contribution limits, same thing. Everything went up a little bit this year, which is great. $7,500 is the new contribution limit. And for those 50 or older, or if you're turning 50 this year, you can do another $1,100 on top of that. So $8,600 could go into an IRA this year. And that's the same, traditional or Roth. But what I do want to call out, and what is sometimes confusing, there are income limits. In other words, if you make too much money, you're unable to directly contribute to a Roth IRA, for example. And you can see those income phase out ranges on the screen there. If you're making more than $153,000 and you're filing your taxes as a single individual, well, then you're not going to be able to put the max into a Roth IRA as a direct contribution. If you're married, filing jointly, you can see that number jumps up to $242,000 as a household. So yeah, just know that if you're looking to save more money, the 401k, for example, that doesn't have any sort of income limitations. But the IRA, you do have to really pay attention to how much did you make and can you contribute to a Roth IRA. The traditional IRA also has income limits, but this is just so that if you want your traditional IRA contribution to be deductible, then you got to make sure that you stay under these income ranges, and which is for a single filer, it's 81,000. For married filing jointly, it's 129,000. But there's the special rule for if you're married filing jointly, but only one spouse has the option to put money into a work plan, let's say like a 401k, well, then that income limitation actually jumps up to 242. So without getting too deep into this, it's just pay attention to your income. Make sure that if you are above those limits, that you understand kind of the consequences if you put money into a Roth IRA or traditional IRA, but you weren't supposed to. The one thing that's not on this screen here, I didn't mention backdoor Roth IRAs. That's something that we could put into a future kind of standalone webinar. But if you are over, let's just focus on you're married, filing jointly. If you're over that income limit, potentially you could still put money into a Roth IRA and it's called the backdoor Roth IRA. But there are some kind of caveats to that rule. You have to make sure that if you do that, best case scenario is you don't already have a traditional IRA. And that just goes into the kind of the accounting rules. It's called this thing called pro rata. If you put money into a traditional IRA and they convert that over to a Roth IRA, that can get complicated if there's already money in the traditional IRA. So maybe just put a little asterisk next to that. If this might apply to you, let's connect, let's talk. I can go over all the rules and details there. The last thing you'll see on this slide here, RMD ages. I just wanted to throw it out there. These are your required minimum distribution ages. So with traditional IRAs, not Roth, but with traditional IRAs, when you reach a certain age, you have to start taking money out of these. And that starts depending on what year you were born. So if you're born between 51 and 1959, your required minimum distribution age starts at age 73. Now, if you're born 1960 or later, it starts at 75. So this is something to pay attention to, just knowing when you hit that age, depending on what year you were born, you have to start taking money out of your traditional IRA, even if you don't need the money. So this really kind of goes into long-term planning around taxes. If you know that you're in a relatively high tax bracket and then all of a sudden your RMDs are going to kick in a few years, that might bump you into a whole nother tax bracket. So there are some strategies. We'll talk about a couple of those later, but transferring money from a traditional IRA over to a Roth IRA, it's called a conversion. That might be something that makes sense. Just know, of course, you'll have to pay some more taxes in the year that you do something like that. But this is where you can already see that the puzzle that is everyone's financial plan is a little bit different. And just understanding the impact of making one move now versus later, what that has on taxes can make a really long-term impact. All right, and I just kind of threw in this catch-all other accounts. These aren't technically retirement accounts, but if you are working and you have the option to contribute to a health savings account or a flexible spending account, those limits in terms of how much you can contribute also went up this year. So the one thing I just want to point out, an HSA isn't available to everyone. So you have to be in a health insurance plan that's considered a high deductible plan to qualify for an HSA. So again, this might be something you have through your work or maybe not. But if you do have an HSA and you are able to contribute to it as an individual, it went up to 4,400. And then if your family's on the plan, you could do up to 8,750. And there's also a catch-up rule for HSAs. Now, unlike the 401k or the IRA where the catch-up starts at age 50, the catch-up for HSAs starts at age 55. Again, I don't make these rules, but just know if you're, let's say, 55 years old and you're contributing to an HSA, you could do up to an extra $1,000 in a calendar year. And when we think about the HSA, if you have one, you might just think, okay, this is great. Money goes into it, and then I use it for health costs every year, which is fine. But I do challenge you to kind of reframe how you think about an HSA. And it can be used for long-term retirement planning because an HSA does not need to be used all in the calendar year. We'll talk about flexible spending accounts here in a second. But in HSA, it can grow year after year after year. And if you put money into an HSA, your contributions, just like a traditional IRA, they can lower your taxable income for the year. So that can give you a tax benefit now in the current year. And then if you let those HSAs grow 5, 10, over 20 plus years, that money can be used for medical costs and health costs later in life. And if you withdraw from the HSA for medical reasons, those distributions can be tax-free. So you can kind of see maybe what I'm saying in between the lines here. An HSA has the potential to be beneficial just like a traditional IRA and a Roth IRA all in one account. This is the only type of an account where you can get that kind of double tax benefit for contributions and for distributions. So that's what I mean by challenge. If you're using this every year, maybe if you can, of course, this depends on your budget, maybe try and pay for prescriptions and out-of-pocket expenses from your savings account or your checking account, just your regular cash flow, and then leave the HSA untouched for as long as you can. Now, all of that said, It is a very different story when we're talking about flexible spending accounts. So an FSA sometimes is referred to as like a use it or lose it. You've got to put money into it, but then you've got to use it, most of it, by the end of the calendar year. You can carry over a small amount. But yeah, the FSA amount is it's up to $3,400, and there's a special dependent care FSA of $7,500. But again, if you're putting money into those, that's where you need to make sure you are going to spend it in the calendar year. So just kind of keep that in mind. It is very different than the long-term planning that I just talked about with the HSA. Uh, I'm not going to spend a ton of time talking about these, but just know this is a brand new kind of addition to the different types of accounts out there are what are being called the Trump accounts. These are for minors, these are for children. And if you have a child that's born this year, for example, you can qualify for up to $1,000 to be deposited into it from the government. Now, there's still a lot of knowledge that we're trying to capture around how these Trump accounts work. But just think of it, if you want to help your kid get a head start on college education or buying a house or something, in their early adult years, this could be a pretty big tool to just save in a tax efficient way until they are 18. So yeah, that's kind of my catch-all for other accounts. Um, I do want to shift and talk about taxes. So last summer, the One Big Beautiful Bill Act came out in OBA. It brought some pretty meaningful changes, and you might be learning about those right now. It's the heart of tax season. You might have already started your taxes, or maybe you're just about to start. So keep this in mind that some of these changes that happened last summer will impact your 2025 taxes. Some of these we're going to talk about are only for 2026 and forward. And I'm going to call those out here in a second. But let's just start with itemized deductions. So for those that do itemize on your tax return, just know the SALT deduction, that is the state and local tax deduction, it's up to $40,400, which means it's probably not something everybody does, but think about maybe a big house project that you did or some big ticket item that you purchased. You might have paid a lot in sales tax. And, that might be something you track, it might not be. But when you know you're going to pay a lot in taxes, this is going to be really crucial that you keep those in a folder, in a file, spreadsheet, whatever you do, because that could be tax deductible. Definitely, if you're itemizing, this is going to be something that you want to take full advantage of as much as you can. But what I really want to talk about are these new non-itemized below the line deductions. These are something that are going to help a lot of people. And for example, the senior deduction, it is new. And this is for anyone 65 and older that are going to file as a single or as married filing jointly, that you get an additional $6,000 deduction as long as your income is below the phase out ranges that you see there. So, for example, if you're filing singly, as long as your income is $75,000 or less, you'll qualify for the full $6,000 deduction. And if you're married filing jointly, that phase out starts at $150,000. But just know if you're making, let's say, $80,000 as a single filer, you'll still qualify for most of the deduction, but that phase out will affect how much of it you'll qualify for. And I just want to call out this new senior deduction. It is in addition to the standard deduction. So if you're not itemizing, if you're just taking the standard deduction, that's great. You're going to get this $6,000 deduction on top of it. So, if your 2025 taxes are pretty much identical to the 2024 taxes and you ended up getting a refund, you'll probably qualify for a little bit more this year. A couple of other things I want to call out is this charitable deduction. So number one, this does not count for 2025. This is going to be for 2026 and going forward. If you give to charity or a nonprofit or your church, any qualified nonprofit or 501c3, you can actually do a below the line deduction up to $1,000 for single filers and $2,000 for joint filers. So, if you give $100 here and a couple $100 there, if in the past you've just been taking the standard deduction, those charitable contributions are great. You're giving to a good cause, but they didn't help you out on your taxes. Well, starting in 2026, they will help you. So again, I'm just going to repeat myself. This does not apply for 25. So if you're scrambling to do your taxes right now, it's not going to apply for last year, but definitely keep those receipts. Just understand the giving that you do this year could help you out on your taxes without the need to itemize. Uh, the last three there that you see on my table, these do apply. These kicked in for 2025. If you are working and you earned overtime, just know that some of that could be deductible. And this is where I have run into some payroll processors that they don't do a great job of kind of breaking down regular pay versus overtime pay. Hopefully that's something that your payroll department is going to be able to figure out. But yeah, this is could be another big benefit. Same thing goes for tips. If you work in an industry where you earn tips, up to $25,000 of that could be a non-itemized below the line deduction. And again, you see those phase out ranges there on the right, starting at $150,000 up to $400,000 for single, 300,000 to 550 for married filing jointly. And then the last one I'll throw out there that just kind of caught my eye. It's a bit of a quirky one, but if you purchased a car recently, potentially some of that car loan interest could be deductible. Now, there are some very specific rules on who this applies to. The car loan must have originated in 2025 or later, and then it has to be on US assembled vehicles. So, this does not apply for every single car out there. But just know that this is a new one, something that we haven't had to track before, but it might apply for your situation. All right, taxes. I know it's a lot. Sticking with the theme of taxes, I do want to talk a little bit about some IRS updates. Again, these are just kind of things that caught my eye that you might have heard of or might not. But one that definitely is a big change, if you ask me, is the IRS is getting away from paper checks. So starting this year, if you're used to getting your refund in a check, that's going away. And also, if you're used to mailing a check to the IRS for your taxes, they're really steering people towards the digital option. And to be clear, the IRS on their website, you can go to their IRS direct pay. If you need to make quarterly estimated payments or any sort of tax payments, you can do it all straight through the website. But this is a big change. Also, this one's just a little funky, but there is a new postmark rule. I don't want to get too into the jargon there, but just know if in the past you kind of wait to the very last second to get your taxes in the mail and you drop it in the mailbox, the moment you drop it in, to you, that kind of counts as, all right, well, that I got it in, it's April 15th, I'm good. Well, just know that if you put it into a mailbox and it doesn't get processed maybe for a couple of days, they're going off when it's processed versus when you drop it in the mailbox. So, this is just my long-winded way of saying try to get those tax returns in a little bit sooner than what you're used to. The IRS really, again, moving away from paper on checks, and I imagine that digital filing is something they're going to encourage across the board. Uh, One more update that you might not have heard of, but for those that live in the South Sound here in Washington, for any individuals and households that live in the following counties, and you can see on there, Pierce County is on that list, that you do qualify for a tax relief deadline instead of April 15th, it's May 1st. Again, I would still encourage everyone try to get their taxes done, as early as they can, hopefully before April 15th, but just in case, there is this extended deadline. All right, that's enough about taxes. I want to shift gears and talk about estate planning and inheritance issues, like I discussed at the top. A couple of exciting things from last year that kicked in. The Washington State estate tax, for the longest time, for many, many years, the exclusion amount was $2.193 million. So approximately 2.2 million if your value of your estate was over 2.2 million, well, then potentially your heirs would have to pay the Washington State estate tax. Well, in July of last year, Washington State they moved that number up to 3 million, and then starting here in 2026, it's now $3,076,000. So there's this inflation factor that's going to have that continue to go up, which is great. And this is just something. If you weren't aware of this, make sure that, especially if you're married and you all of your assets are combined as a married couple, there is some unique estate planning tools. Specifically, you can create a testamentary trust within your will to try and avoid some of these taxes or maybe altogether avoid them. But it does take some careful planning. Again, that's kind of a good teaser or preview for our future Wisdom and Wealth, where we dive into estate planning with a lot more specifics around how that works. But yeah, just know that in Washington, it used to be about 2.2 million. Now it's over 3 million for the tax exclusion. The lifetime exemption amount there, you can see at the bottom, that's the federal number. So when we're talking about Washington, and for us Washingtonians, that $3 million is what we need to pay attention to. But just know at the federal level for federal taxes, it's 15 million. And this is, that's a really high number. It's moved a lot over the last 20 or so years. So pretty much just keep in mind all of the rules that we talk about. Congress could change things on us. So yes, it's good to know these rules, but it's also even better to know the rules could change. And then you'll see right there in the middle of the screen, the gift exclusion. It's still 19,000. This actually didn't change from last year. But if you want to give to another person, a family member, you can give up to $19,000 with no tax reporting required. And there are ways to pretty, easily double that. If you're married and you and your spouse want to give to a person, you and your spouse could give 19,000 each. So there's, $38,000 you could give to someone. Or if you're giving to a married couple, you could give it to one person and then give it to the spouse. So there's some unique ways if you're looking to give more. But what I always like to point out with gifting is, let's say you give more than the 19,000. Let's say you give someone $100,000. Maybe you want to help one of your kids buy a house or whatever the reason. Just because you're going over that gift exclusion amount doesn't mean you have to pay taxes. It just means that you need to report it on your tax return. As long as you stay under that lifetime exemption number, see at the bottom there, that 15 million, the taxes aren't going to be owed. But again, this is something you need to report on your taxes. And you might be asking, why would someone want to do that? Well, if we go back to the Washington state estate tax, let's say you have a net worth of $3.1 million and you're trying to get that below, well, it might make sense to give away 100,000 or 200,000, whatever it is, to try and reduce your taxable estate so that you don't have to worry about the Washington state estate tax. Again, not paying taxes, just a little bit extra work you got to do when you file your return. And again, this is just kind of the tip of the iceberg when it comes to estate and inheritance planning. But if you have more questions, if you want to go over this in more detail with your specific situation, give me a call. Definitely happy to chat about it. All right, let's talk about something that definitely has been, I don't want to say a stress point for people, but this is something that's a little more complicated. Inherited IRAs. So if you are inheriting a traditional IRA, there is this rule. It's relatively new. It's called the 10-year rule. And as you can see on the screen there's this really big flow chart. And I understand, I think my face is covering up some of it. But if you'd like this flow chart, if you want a copy, again, shoot me an email. I'm happy to send this to you. But what you really need to understand is if you're inheriting an IRA from someone other than your spouse. So let's say you're inheriting it from, a family member or from, just a friend. And if you are an adult, you've got 10 years to empty that account. So that's number one. You've got to remember, if you inherit a traditional IRA, again, a tax-deferred retirement account, you've got 10 years. The clock starts ticking. You've got to withdraw everything. And of course, that means any distributions that come out of that IRA are taxable. So this is going to kind of change, the tax equation for you for, potentially up to the next 10 years. So that's rule number one. You've got 10 years to empty the account. Rule number two is, depending on the age of the decedent. So in other words, if the person passed away past their RMD age, so if someone was already receiving their required minimum distributions, let's say they're in their late 70s, early 80s, they're receiving required distributions. That means when you inherit it, you must also continue those required distributions. There's a formula to calculate what that number will be, in addition to the 10-year rule. So it's not like the 10-year rule means you don't have to do anything for 10 years. No, there's still probably a small amount that you need to take out along the way. Now, this is where everyone's specific tax situation is going to make things tricky. You've got to really understand what tax bracket you're in. And let's say that you're about to retire in a couple of years. So you're in a high tax bracket now, but you'll be in a low tax bracket in a couple of years. Well, in that scenario, you might want to just take a little bit out for those first couple of years and then increase the amount in those remaining years when you're in a lower tax bracket. So that's just one example of kind of all the idiosyncrasies that, depending on your situation, there might be a different strategy for you compared to your neighbor. So, but just keep in mind, inherited IRAs used to have very different rules. The 10-year rule is something that you've got to be aware of. All right. Now, thinking about reducing your taxable estate or reducing taxes overall when it comes to estate planning and inheritance planning, there are some charitable giving strategies that you might not be aware of. And maybe if you are, you don't know the rules. So I want to go over two of those today. And those are qualified charitable distributions, a QCD, and a donor advised fund, so a DAF. If you're Googling these later, again, if you type in QCD or if you type in DAF, that's what we're talking about. So let's start with QCDs. These only apply, so you have to be at least 70 and a half years old. And this is anytime that you directly give to a charity from your traditional IRA, and you can give up to $111,000. So what does that mean? So let's say, you're 71 years old, you have a really large traditional IRA, and you're already giving. You're giving money again to your church or to a nonprofit or a 501(c)(3). Instead of giving by just, writing a check, you can do a direct charitable distribution from your IRA that goes to that charity, and that is a tax-free distribution. Because remember, anytime that you take money out of an IRA, those distributions are taxable. It increases your taxable income for the year. Well, if you give it directly to the charity, then you don't have to pay taxes on it. And I have used that word a few times now, directly. That is the key. It's not like you can take a withdrawal from your IRA, put it in your bank account, and then write a check. That is not direct. To do a QCD, you have to work with your financial professional, or if you're managing on your own, you just have to have it sent directly from the IRA to the charity. So that is a pretty big distinction there. I'm going to show a flow chart here in a second on, again, just kind of bird's eye view, the mechanics of how it works. But yeah, keep in mind that if you're over age 70 and a half, which I do want to call out, that used to be the RMD age before they moved it to 73 or 75. But for some reason on QCDs, they left that 70 and a half number. Congress comes up with some funky rules. I'm not in charge of that, but yeah, there still is a 70 and a half rule floating out there. The other charitable giving strategy I just want to put on everyone's radar are donor advised funds. So a DAF, it provides a lot of flexibility when it comes to charitable giving. So this is, think of it as kind of front loading your giving strategy for the next 10 years. So example, if you're giving, let's say, $1,000 a year to a charity, or maybe you're giving up to $10,000 a year in different organizations, doesn't have to be all to one place. Instead of just doing the 10,000 per year, what you can do is say put $100,000 into a donor advised fund. That counts as all at once. That is a charitable contribution. So for tax reasons, it's like you gave $100,000, but you get to control the pace of how quickly that money is given to the charities. So you could put $100,000 into a DAF all in this one calendar year, get the tax benefit for all of this year, and then next year give out 10,000, and 10,000 a year after that, and so on and so forth. You do get to maintain some control of how it's invested, and of course you get to maintain the control of where the money goes, but that money is given away. So, I just want to call out, it's not like you can change your mind and reverse that. The money that goes into a donor advised fund is meant for charity. And you might be thinking, all right, well, why would I want to do that? What's the point of front loading? For a lot of us that don't itemize on our tax return, like we talked about earlier, there's that new rule, you can give 1,000 or 2,000 without itemizing. Well, let's think of like a unique situation of maybe you sold a home. Maybe you sell your house and all of a sudden, you've got a lot of money that comes in one given year. It might result in a really big tax year, and you're trying to offset some of those taxes. Well, you could take some of the proceeds of that home sale, put them into a donor advised fund, get a lot of the tax write-off in that one year, and then again, you get to do your charitable giving throughout the next 5, 10, 20 years, however long you want to do it, so that you actually save money on taxes in that one year where your taxes were a little unique. Long term, I also like to point out a donor advised fund is great for legacy planning. If you want to leave a legacy so that your kids or your family members can continue to give after you're gone. A donor advised fund is a really great way to do that. And like I said earlier, I've got some pretty fantastic flow charts on here. I know it's a little blurry, it's a little hard to read, but again, just understanding how a QCD works. If you have more questions, give me a call, let me know. I do want to call out there is one kind of caveat to a qualified charitable distribution. If you want to do a QCD, it can't go to a DAF. So if you're looking to do a qualified charitable distribution, it can't go into a donor advised fund or a private foundation. It has to go directly to that charity. So that is one caveat as we're talking about both these concepts. Just make sure you keep that in mind. And then, yeah, with a donor advised fund, this is really impactful for those unique years. Maybe you've got some appreciated stock that you're going to sell, or maybe you have some stock options that you're going to sell. Just think of those unique years where you're going to have an unusually large income. So you've got to potentially offset some of it with giving to charity. The donor advised fund. It's a really, really great way to do that. All right. So, a couple of takeaways, retirement updates. Just if you're contributing to your 401k and you're trying to max it out, make sure you go in, you kind of fine tune your what you're doing into the pre-tax or into the Roth. And again, just know that if you're a high income earner of over $150,000, those catch-ups are going to go into a Roth. And in understanding that long-term impact, and also in the short term, what's that going to do to your taxes? Tax planning, again, if you are working and you're going to be in a different tax bracket, adjust your W-4, adjust your tax withholding. But these new deductions are going to help out. So if you're over the age of 65 and you're probably going to get a larger tax refund than you're used to because of the new senior deduction, yeah, just understand that impact. And then estate planning. I really did just kind of do the tip of the iceberg today when it comes to estate planning. But yeah, review your state. If it's been a while, if we're talking it's been 5, 10 years since you updated your estate plan, it's probably a good time to take it out. Review it with a professional or go reconnect with your attorney. And also, if you've had life changes, maybe you moved, maybe your kids used to be minors when you created your will, but now they're adults. It's really important to understand that. And of course, the new thresholds. So, in Washington, if you're right on the edge of that $2.2 million Washington State estate tax exclusion, now you've got a little bit more breathing room, but I still would say it's important that your plan is up to date and it does account for all those potential changes that, hopefully your portfolio is going to grow over time and it'll probably outpace how quickly they increase the exclusion amount. So that was a lot. I know I kind of zoomed through some of that. I'm happy to go over anything again. Again, my contact info right there. Let me know. Here's our disclosure page just to make sure we get that out there. But 2026, we're off to a good start. We're keeping an eye on some things so that I didn't create a slide for this, but I did just want to share, a couple of things that we're paying attention to as a wealth management firm. We're keeping a close eye on this Washington state millionaire tax that's going through our state Congress, just kind of understanding the potential impacts of that. Of course, we're keeping a close eye on this AI trade. So artificial intelligence it's making headlines. It's obviously driving the economy. It's driving stock market ups and downs. We're paying really close attention to that. Tariffs, I don't think I can have a conversation or a webinar without at least bringing it up. They're on, they're off, they're here, they're gone, they're legal, they're not legal. Obviously, a lot of the volatility in the market over the last year plus has been around tariffs. We're keeping a close eye on that as well. So I would love to answer some questions. I don't know if anyone has any questions in the Q&A. I don't think there are, but this is the time. If there's something that I went through that you want me to recap, let me know. Type it into that Q&A there. Or maybe it's a topic that we didn't discuss. I can't promise we can go off on a tangent, but definitely happy to answer any questions you might have. So I'm going to pause. I'm going to take a little bit of a breather here. Let me know. What do you have? Happy to chat. Jordan, let me know if I missed anything too. Okay, Kathy, I see we've got a hand up. Let's take a look. All right, so Kath, let's see, we've got There we go. Kathy, can you hear me?
Yes.
Yeah,
Uh,
yeah. What can I
I,
help with?
I wanted to know if, let's see, back to the limitation, I think it was for seniors, $150,000 income. Is
Hmm.
that adjusted gross income or is that gross income?
It's sorry, modified adjusted gross. So I believe it's the Magi when you're thinking about it. So it'll
And
be one where if you're contributing to like a 401k or an IRA or something, that could help you out and get that down. But it's like gross income, but yeah, there's a couple of caveats to that.
hmm, okay,
But it should
thank
it should help. Yeah, it should help you out even if you're in that range.
And
thank you.
we do have a Q&A in the box as well.
Oh yeah. Let's see. We got Lisa. Yeah, asking on the QCD, is the 111,000 deducted from your RMD if it is higher? Oh yeah. So I think I'm understanding the question. Yeah, this is a great tool when you reach your RMD age, or required minimum distribution age. Let's say you don't need the money, so you want to just give it to a charity. You can do that through a QCD, and then you don't have to pay taxes on those distributions. Yeah, and if your RMD is, let's say 200,000, well, 111,000 of that could go to a charity. Of course, the rest though, you do have to take as a distribution that's taxable. Hopefully I answered that, but yeah, let me know if I didn't. Okay. Gonna give it another minute. Last call for any questions. I'm not seeing anything come through. So I just want to share again, thank you so much for attending the webinar. We are going to put this up on our YouTube page in a week or so. And I'm happy to talk about any of these topics. If you have more questions, reach out, schedule a meeting, Zoom, phone call, in person. Happy to chat with you. But yeah, from everyone here at Financial Insights, thanks so much. Have a great day.